Hello, Dr. Trader is back. This week, gold presents an unusual conflict. Price has edged above weekly trend SL during the session. Institutional positioning leans supportive, and the dollar is under pressure. Yet an intraday move is not a completed weekly confirmation. The real question is not whether gold currently leans bullish. It is whether the evidence is strong enough to trust the move before the week has actually closed. The trap is getting the direction right, but the timing wrong. Gold futures are near 4,453, only about 0.3 above weekly trend SL. That margin is too thin to call a durable breakout. In a ranging market, price can cross a technical boundary and then rotate back toward average value. Traders without exposure should distinguish an intraday print from a weekly close. Traders already holding exposure should assess their own risk against the structure instead of assuming that a bullish label guarantees what happens next. The macro picture is pulling gold in both directions. Softer inflation evidence can reduce pressure for tighter policy, but the U.S. 10-year real yield remains near 2.4%. A high real yield raises the opportunity cost of holding an asset that pays no income. A weaker dollar offers some support, although that signal is not strong enough to carry the thesis alone. Treasury general account rebuilding may also drain liquidity from the system. CPI on August 12th and PPI on August 13th are still upcoming events at the time of this analysis. The reaction in yields after those releases will matter more than the headlines themselves. The price map has 3 reference points. Gold futures are near 4,453. Weekly V-WAP is 4,444.36, while weekly trend SL is 4,452.7. Price is above both, but only marginally above trend SL. That is a test from above, not a completed weekly confirmation. The thesis snapshot was recorded at 4,424.4, so much of the advance happened before confirmation could be established. V-WAP is the near-term balance line. Trend SL is the structural boundary that matters into the weekly close. The bullish case becomes more credible if gold closes the week clearly above trend SL at 4,452.7 and continues to hold weekly V-WAP. That would show the current move is more than intraday noise. The case would also benefit if incoming data brings real yields lower and the dollar remains soft. These are conditions for judging the thesis, not a price target and not a buy signal. Until the weekly session is complete, confirmation remains unfinished. 3 risks remain active. Elevated real yields still work against gold. The ranging regime increases the chance that a narrow breakout reverses toward average value. And a sustained loss of weekly V-WAP would show short-term momentum turning against the bullish thesis. A broader liquidity drain linked to Treasury cash rebuilding could add pressure if markets begin selling risk indiscriminately. None of this guarantees a decline. It defines the conditions that would make the constructive story less reliable. The practical conclusion is simple. Gold still leans bullish, but the evidence does not yet support treating this as an actionable setup. Traders without exposure can wait for the weekly close to confirm trend SL. Those already holding exposure should assess their own risk around trend SL, V-WAP, and their personal limits. The key is not to mistake an intraday crossing for a completed structure. Follow Intermarket Edge on Telegram, X, and our website for the full price map, macro updates, and the next intermarket analysis.